All right, welcome to this episode of Real Estate Chat with
Robert Eid.
and John Perez. Robert, do you know what we love most on Real Estate Chat?
Comments?
Comments. When our real estate chatters chat with us on Real Estate Chat. And so we're going to start this episode off with a comment from Dennis, and I hope I pronounced your name correctly. There you are right there. Based on the chart from May to June, seems like sales dropped more than just seasonality. Do you know the average drop from May to June historically and what was now? So for those of you real estate chatters, or if you're first time joining us, if you watched the previous episode, we dissected through Robert's charts and stats, the June figures. And one of the figures, as Dennis pointed out, we talked about the drop between May to June. And now what Robert and I said is that typically May to June sees a drop in sales on an annual basis, because that's the thing that normally happens anyway. Now, when you read the Financial Post, when you read the various newspapers and media, and anybody else who puts a spin on this out there, they cite it too. Interest rates have gone higher. People are feeling less confident, and therefore sales are dropping. The sky is falling. Robert, anything you want to add to this as a preamble before we look into the data?
Well, the question is twofold, as you say. What happened? And then the more important one is why. So let's look at the data.
Yeah, so let's look at Robert's chart. Robert, let's revisit this from our last episode.
All right, sales are lower.
Significant.
In May. So we had to do some backyard calculating, and John just got the historic for us to be able to come up with an answer to your question, Dennis.
All right, so let's look at it. And here's what a typical, well, I guess it's not typical. This is what years from 2008 up until 2023 look like. And to Dennis's point, yeah, the 2023 May to June percentage difference in sales was significant, minus 16.86%. And when you're looking at it from this chart and you see a massive pop up in terms of sales in 2020 from May to June was a whopping 88%, which we're going to deal with that later, right, Robert?
Yep.
You see that typically when you're looking at these figures, at least from 2008 to 2023, the average dip May to June is about 1%, 1.15%. Forget about the max, because this is an anomaly. And the minimum, the lowest drop was minus 21.59%, which happened in 2017. You recall what happened in 2017 with what happened back in 2017, Robert?
Well, this is the change between June of 16 to June of 17. So in March of 17, we had provincial government intervention with about 20 different ways to screw up the real estate market, and it worked.
And this is why sales dipped back then, right?
Yep.
And now you're looking at a median point of minus 8.34. But you know what we're going to do?
What?
The magic of Zoom and screen sharing. We're going to hop onto the actual charts that were produced to make this. So if you're looking at this chart, Robert, you were telling me earlier that what if we wiped out 2020 altogether? What would happen?
Well, it'll change your averages because that's such a hugie.
Yeah. So let's say, for example, 2020 did not happen, right?
Yeah,
So
okay.
under that scenario, you'd be looking at a typical drop from May to June of minus 6.66%.
Yeah, they're all red.
And we're pretty much all in the red. And so a 16% drop still is significant, to Dennis's point.
He was right.
It's not
right.
as
It's
exactly.
like more than twice what the normal drop is. Yeah.
Exactly. Now, 2020, you told me, what if it was what was the typical average here, like about a minus 10 drop? We're seeing that happen quite a bit, right? So if you had in 2020, a minus 10 drop, you're still looking at average at still at 7%. Right now, if you had an increase in 2020, let's say that happened, and the highest increase at this point, if you're looking at max increase without the 2020 market was 14%. Let's say we did a nominal 10% increase. You're still looking at an average of 6% as a drop over time. So let's put back the real number that happened there, even though that throws off the averages. But if you looked at the previous numbers that we've calculated, you would see a typical drop of 6 to 7% in the May to June month-to-month comparisons. Now, Robert, you talk about, well, before we started recording, you talked about why seasonally adjusted happens. Is seasonal adjustment relevant here in order for us to kind of smoothen out this plus minus of sales difference, or does that distort perception even more if we're using seasonality, seasonal numbers rather?
Okay, well, if we are in the real estate business and we care about June because we're in June or we're in July or we're in May, we want to know what happened exactly last June. And we don't want to try and find a way of artificially using an algorithm to make every month the same, because every month is not the same. December is not July. February is not any other month. And so we want just the actual numbers of what it is. Now, if we're sitting and we're trying to come up with global policy for the Royal Bank and make a comparison for all these markets, then seasonal adjustment does take the irregularities, the seasonality out so that every month is the same. But guess what? It means that some of the time you're completely wrong up, and other times you're completely wrong down. In the end, after the course of a full 12 months, it probably is okay. But again, if you're not on the ground and you don't care about what's actually happening now, you can use that. But it's an artificial comparison.
So it's kind of like just massaging the numbers to come to some sort of a conclusion. But in reality, these are the actual sales figures that you should be looking at. So, Robert, we talked about the factors that are affecting this seasonality. So to Dennis's point, yes, you're right. In addition to seasonality, there's a whole bunch of other factors. And, the Bank of Canada released its monetary policy report, and we're going to look at some of the charts on that. Robert, why don't you take us through the monetary policy report, the charts that you wanted to talk about in this episode?
All right. Well, the report came out yesterday with the press conference and the rate hike, which I'm going to say was probably expected. More and more people are going to be more and more disappointed as this governing council of the Bank of Canada continues to raise rates based on what they are looking back at rather than what they should be looking forward at, because they want to be data driven. How can you be driven from the rear when you're trying to forecast the future? You're looking backwards in the rear view mirror. Anyway, so where real estate shows up in their report, this is page 12 of a 28 page report. And on the left-hand side, chart 9, housing resale activity and prices have picked up in recent months. Now, this is supposed to validate their feeling that inflation is still roaring. And so the policy of pausing must be discontinued, and the policy of increasing the rate and quantitative tightening, which is another whole thing, must continue. And that's the right thing to do. So what have they used? If we look down below that chart, we see the blue line is new listings and residential resale. So they've gotten this from the Canadian Real Estate Association, and the Bank of Canada done some calculations. Now, where did the Canadian Real Estate Association get it from? They took it from all of the member boards. What's the biggest board by like a factor of 9? Toronto. So when we see the new listings tick up, again, our double counting of do-over listings in the Toronto area is being reflected in the Bank of Canada's policy report and influencing their thinking on what the state of the art in the Canadian real estate market is, which, number one, it's impossible. It's not one thing, it's 75. And we know in Toronto, the biggest component is got a bloated number. So I picked that as one of the charts that, if we were in another business, maybe we pick another chart of saying, these fellas don't know what they're talking about really, but they're finding everything that they can to justify the position that they've already decided to take.
Well, again, too, we're not economists. Robert and I are licensed real estate professionals in the area of practice that we're licensed in. And you got to keep in mind that a whole team of economists and experts and whatnot come up with these monetary policies based on these reports. But if you've watched previous episodes of Real Estate Chat, you'll know that there's a flaw in the data that is being fed into these reports. So to Robert's point, yes, if you're making a decision based on data that it's not quite perfect, and I mean, nothing in this world could be 100% reflective of pure perfection if you're trying to come up with these decisions, but you try to do your best, then of course your decisions as far as your policies are concerned are going to be affected by the data and the quality of the data that you're getting. Let's look at this chart here on the next.
This is from page 21 of the 28-page report, and it's in beautiful color. And what it shows, and you can see where the start of forecast starts, Q2 of this year. And so they see the big, oh, it was terrible. Look what inflation used to be. And they got the components of what it was and all like that. And then starting with right now, the heroics start taking effect and it's going down. And it's pretty soon it's going to be down to dirt. But well, we don't want it to be dirt. We want it to be 2. So just a second. Is this a good chart or is this a bad chart? It's a bad chart. We're never going to have 0% inflation. Their target is 1 to 3. We call it 2. And again, everybody's got a job to do. They got a job to do. And we have to suffer the consequences of if they are wrong. And their biggest lever, their biggest, if I only have a hammer, then everything is a nail, interest rates, then they have hammered this interest rate and they're killing the economy. And the reason they had to raise interest rates is because they kept it too low for too long. So we're all going to suffer.
And let's look at what those interest rates are. So going back to our charts here we are. This is where we're
the
sitting
Financial
at.
Post this morning, yeah. So you can see it goes back to the turn of the century, and 6%, and then we had a batch at 4%, and then they had a terrible time. In 2009 was the global financial crisis, monetary crisis, whatever you call it. So they had them at 1% for a long time. And then they had to go down a bit more. And then they edged it back up again, thinking everything was great. And then, oh man, COVID. And so they went right down to rock bottom again. And all through here. And then they had to try and recover very fast. What took them 5 years, 15 years to go down, they had to get up in 1 year. And that was a shock to a lot of people's system. A lot of people made decisions to take short-term mortgages based on the assurance that rates were going to be low and for a long time. And so whoever it was that said low and for a long time has got to take responsibility for the people who made decisions based on that assurance. And that was the Bank of Canada governor, and his name was R. Tiffany Macklin. But he's not taking any responsibility. He's thinking he's a detached observer and he can do whatever he wants. No, he can't. He should be fired tomorrow.
Strong words. Well, at the same time, it is reality that we're facing.
Yeah.
Right. I mean, in as much as at least I try to avoid as much political angle on our real estate chats because we're looking at pure data here. Let's face it, if you are on a variable mortgage, you're feeling this. And to Robert's point that he talked about earlier too, these rate hikes won't be felt immediately. Like you're feeling right now the lack of the rate hike in the spring. Like there was no increase in the spring, and it let the market continue on. And it happens to be the best real estate market every single year. But now you've got consecutive increases that have happened. We're sitting at a 5%. So fixed mortgages are what, 7% now? Or variable mortgages are are going to reach up to that point as well. And that affects.
And then you got the stress test to qualify unless you're renewing.
The stress test goes up as well. So that affects. And let's take it to, well, first of all, I'm going to share with you, if you like reading this stuff, as Robert and I do, we'll link it in the show description here in our show notes, monetary policy report. Go ahead, read through it. It's just lovely reading. It gives you at least a little bit of insight into how the government's thinking.
Go to the very end, last page. So he talks about risks to risks to the outlook. Of course, you won't be able to find it. No, it's like page 27.
Oh, way at the back. Sorry. Yeah. Okay. 24.
Yeah. Main downside risks. Past increases of intermediate fine goods could reverse. Now, that might be a good thing. If the things that were shoved up too high in price because of the supply chain shortages, or people did a little gouging saying, well, I got to get my prices up, so this is a good time to do it. If they brought those prices down for wallboard or for nails or for whatever, then you would think that that would be a good thing. But no, it's a downside risk to their projection, because it would make their projection more wrong. Now, global activity could be weaker. Well, that's what's going to happen. So it's going to change. It's going to give them an out on why they can change their policy. If you go above that, there's upside risks.
Yeah, and it's going to be one of those. It's going to be one of those.
It's their report, and it covers their Butox 6 ways to Sunday.
And it's going to be one of those, time will tell. But when you look at the media, and this is one that Robert loves to read, Financial Post, Post Haste, there's surveys done by our fellow realtor brokerage Zoocasa, and they talk about what the impact is on real estate. Now, of course, they say that in the spring, because of the spring market and how healthy that was and how jubilant it was, the decision to hold rates had a positive impact. But now, course, early numbers for June, and we went through the June numbers, the final numbers already, in terms of the actual home sales, that it went up, then it dipped. Beyond seasonality, it dipped because of consumer confidence, right? And basically the poll said that more than 70% of those polled said another increase by the Bank of Canada would negatively impact their interest in real estate. So remember, a couple of episodes back, we talked about sentiment when it comes to surveys in terms of how do you feel about being able to pay your mortgage? And now here's another survey that says, with the rate increases, how do you feel about your interest in real estate? More than 63% did not expect housing to become more affordable within the next year. And for now, they are prepared to wait. What's the significance? And we'll link that too in the show notes. But Robert, what's the significance of this sentiment, of what people are feeling out there?
This is what your initial commenter, Dennis, was saying. If this is more than normal, why was it more than normal? And that post haste was written by a particular person who the sky is perpetually falling and finds things that agree with her, the sky perpetually falling. And like our old friend Garth Turner from a long time ago, the sun, every now and again, he's completely right that the sky is falling. So the everybody is wondering what's going to happen, especially in a transition. Now we're in a transition. We had a boom that nobody was expecting in the middle of February, March, and April, like crazy prices and buyers buying and overbidding and all the shortage of listings, and nobody knows what to do. And now we have summer, and now we have the end of that now we're seeing a lot of investors dumping. You look at the condos, they finally got rid of the tenant. They're up for sale at an advantageous price and a hold date, and they're dumping something that they bought in 2021, thinking that they could rent it out and make a fortune as prices went up, and now it's not working out that well. And for the first time in a long time, I'm going to Oshawa tomorrow, and I see comparable listings to the one I'm showing where it was bought last year when they're going to rent it up and down. Obviously, Toronto broker brought them out there for lower prices, and now the price is just going nowhere. So those people are bailing, saying, well, there's no reason for me to hold on to this. I don't live there. It's empty. I'm selling it. I'll take a capital loss against some of my other investments. So normally real estate is a place to live. You choose your neighbors, you choose your community. It's a long-term investment that you pay off the mortgage, and it's security of tenure. Instead of someone owning the property that you rent and being able to say to you at any time, okay, I want to take it back, or I'm going to change this, or I'm going to change that. You own it. You have security of tenure. And so I don't know whether this is answering the question or not, but so right now, June, you got some people who know for sure what we're doing and they think it's bad. Some people know for sure they think it's the same as it always was, and they don't know they're wrong yet. And by September, we'll see whether things are very much tempered or roared back. I don't think it's going to roar back, but I've been wrong before, as we all know.
Well, and on that note, we're going to look at Robert's forecasts, hopefully in our next episode of Real Estate Chat. Make sure you leave your comments. Thank you, Dennis. And I hope this answered your question. Thank you for all of you who continue to support. Make sure you click like if you dislike. Tell us why. Put it into the comments.
Yeah, why? Why is the question we want to answer.
But then, of course, we'll see you in our next episode of Real Estate Chat. Take care and bye for now.